Josh Denbo, consumer protection attorney. My expertise is in housing and mortgage servicing and mortgage origination, fraud, and abuse. That's what I do 90% of my practice. And of course, once you become an expert in consumer protection in one area, people come to you in others. So it's always expanding. But that's really the expertise that I've got. And one of the cases that I've been looking out for about 20 years has crossed my desk, and now I've seen at least one more in the last 2 weeks, and that is something called the inability to pay on the origination of the loan. So prior to the collapse, in 2008, mortgage companies were buying as many loans as possible to sell on Wall Street. Wall Street was securitizing. We've all seen The Big Short. You all know all that crap. There was no law in the books that prevented a mortgage servicer from a mortgage originator from selling a loan that the borrower couldn't afford. It just wasn't a thing. Caveat emptor, buyer beware. Don't buy something you can't afford. But there are a lot of poison pill loans where the loans would be really low for 5 or 6 years. The mortgage originator would lie about it. People would buy it, and then they'd lose their houses when the market crashed. In 2010, when thanks to Obama and Elizabeth Warren, and I don't give a shit what your politics are, that's fact. Thanks to Obama and Elizabeth Warren, we got the Consumer Finance Protection Bureau, who took over the mortgage origination servicing regulations and imposed a new, and Congress passed a new statute in the Truth in Lending Act that required originators to assure themselves and the investors who might buy the loan later that based on the finances of the borrowers at the time of closing, that they had the ability to repay the debt. Now, look, anything can happen. People get sick, life changes, jobs are lost. Not every loan is going to be repaid. But there is at least a requirement under federal law that the mortgage originator make a determination that at the time of lending, that there was enough money, income, or savings in order to repay the entire debt without resort to the collateral, without resort to a foreclosure filing. Well, there was an entire generation of mortgage originators who were so traumatized and aware of the deadly problems associated with selling loans that just aren't affordable that you just didn't see those cases. But you're starting to see them now, because morons who don't have any experience, as opposed to morons who do, or originators who don't care, or originators who don't realize how the law actually works, are starting to sell loans to people who can't afford them. And the case that came across my desk is a couple. He's a mechanic. I mean, it's a really great career, but he doesn't make a whole lot of money. And she ended up with a personal injury settlement of about $200,000. And she got hooked together with a realtor and a mortgage originator who sold them a loan. And the promise was, look, it's 9.5%, but after a year you can refinance and then you'll be able to afford it. And so after a year, when they closed, which they didn't make any determination that the loan is affordable, it's not. The monthly payment is 3/4 of the gross monthly income. It's not affordable. So after a year, they went back to the loan originator and said, okay, you said we could refinance to a lower rate. Let's refinance. Oh, no, we can't. You can't refinance. So they burned through all of their savings, not knowing what else to do, started being threatened with foreclosure, found me, we filed suit. And I've seen that again. And it's a violation of the ability to pay rule of the Truth in Lending Act. And if you've been placed into a loan without the mortgage originator making a determination that you could afford it, yeah, maybe you shouldn't have signed it. But people make mistakes, and people get defrauded, and people get tricked. So I don't want you looking at this and saying, this is my fault. Look, there are rules regarding mortgage origination. There are rules regarding loans that apply to the industry that sells them. And if the industry violates those rules, don't beat yourself up about it. Go fight back and start addressing your rights, which are considerable. So we're going to see a lot of these claims because the market is starting to turn, because mortgage originators were making money hand over fist, because there's just a lot of money out there, and housing just made sense, but now it's not making as much sense, and the mortgage originators are fighting for over a smaller piece of the pie. They're going to start cheating, and people are going to start getting hurt, and you have rights. So I hope this helps people out there. I only practice in New Jersey. I don't have contacts in every state, but I have them in some. So if you've been hurt in another state, still reach out. I'll see if I can't see if any of the attorneys on my my Rolodex might be able to help you. All right. Good luck.